Good afternoon, everyone. Thank you very much for being here with us in this very interesting and very fascinating event. I would like, before starting the panel, to thank Andrej Kovarik for his fantastic work in the last 5 years in the field of digital finance, his dedication in creating a competitive financial system for Europe based on innovation, based on open-minded approach, and we are hoping this excellent work to be continued in the coming years. Now, I'm honored to have here with me a fantastic blend of people, blend of talent, coming from the industry, for the academia, and for the policy making of the European Union. And we are going to discuss something that hopefully is going to make the European financial system more competitive and more relevant in the coming era of digital economy. I would like very, very briefly to ask our friends in the panel to introduce themselves, starting with Marianne.
Thank you. Hi, Marianne Weber from Standard Chartered Bank. I'm the head of regulatory strategy for digital assets. I've been at the bank around 7 years, and prior to that I was at the UK Financial Conduct Authority for about 7 years as well, working on a range of policy issues.
Peter?
Hello, I'm Peter Kerstens. I'm advisor for technological innovation and security, cybersecurity at the European Commission's Financial Services Department. And I've been at the European Commission for as long as I can remember.
Hello, thank you very much for having me here. I am a professor of finance at the Judge Business School of the University of Cambridge. I am also director of the Center for Finance Technology and Regulation. I've been a professor of Imperial and MIT before, and prior to that I was chief economist of the U.S. Commodity Futures Trading Commission.
Yes.
Yeah, good afternoon, everyone. My name is Hachmeister. I'm a managing director at Deutsche Boerse and Clearstream, with Deutsche Boerse for over 20 years, and currently in the role of heading Issuer Services, New Digital Market, Data and Connectivity. And since 2017 in the digital journey, and in that capacity responsible for some of the digital infrastructure we have brought up, like our vertical around digital collateral, HQLX, or D7 as a new digital market infrastructure.
Thank you. Joshua?
Is it? All right. Hi. Good afternoon, all. I'm Joshua Daniel. I work for JP Morgan, based out of the London branch. Within JPM, I lead the R&D within the coin systems. What I mean by that, so within ONYX, ONYX is all things to do with blockchain. We build products around that space. And coin systems is all things to do with movement of money or value. So I look at building products and essentially movement of value. Yeah. Thanks.
So we really have a wonderful blend of people, and for those who know me, I'm a very practical person, though much of what I'm doing is informed by theoretical analysis. Well, we will be very practical today in this panel. In the next 45 minutes, we will try to cover as much space as we can around 3 fundamental topics. The first is the tokenization of financial instruments and real assets. Is this something that actually generates value? Should we do it? Then, financial infrastructures. Should we take further steps towards this direction? Do we improve the market efficiency and the economic efficiency of transacting value on-chain, or it's better to do something better with our time? And third, does the tokenization of value and DLT-enabled financial infrastructures accelerate and augment the competitiveness of our financial system, making it more transparent, efficient, and inclusive? So, hopefully, we will address these issues. And the protocol says that I have to start with the European Commission, However, I got permission from Peter Kerstens, and I would like to give the floor to the industry, starting with the tokenization of value. I would like to explore how value is generated if we tokenize an asset. And I would like to start with Joshua.
All right. Well, thank you for the first question. So in terms of, possibly I can talk about what we've done within ONYX. Essentially, so within ONYX, as I said, we have three parts. One is ONYX Digital Assets, looking at tokenization of real-world assets. The second is ONYX Coin Systems, which is about bringing the cash leg, so to speak, right? So this is where we have JPM Coin Systems. And then we also have a layer which is around information, so a link. So the data, assets, and the value of the cash leg. Within assets, I mean, it's much broader in the sense, so we're sort of live today with, the first use case was intraday repo. So that's an example where traditionally you would do a repo trade, you settle overnight. But today you can, as an institution, do a repo, let's say 9 o'clock in the morning, London time. And if you have enough liquidity, you can come back and close that 9:30, right? So it's very much, reactive, real time. And that sort of is underpinned by, for example, the cash leg, as I said, the JPM Coin System, which is equally about having that fundamental of being able to move liquidity or money 24/7, 365 around the globe, right? So we sort of interplay and use that cash leg in the asset side. Another side of things, another use case is collateralization. So a collateral network, which is the idea would be that you should be able to collateralize any asset, right? Be it anywhere. So tokenization provides that fundamental, the basis to do that. The third would be around digital, securities or bonds, and that's a future we're going where traditionally clients we've seen doing large bond issuances, let's say around 600 million, but now we're seeing more where clients want to do what they call micro bonds, like maybe 10, 20, million. The idea being that clients find it hard when they do these large issuances that they do traditionally, which is what you do with all this cash suddenly, right? So having a very efficient, cost-effective infrastructure to have these digital assets is one of the other angles around, assets as well. I'll pause there.
So the motivation is cost reduction, right?
It has to be, I would say, fundamentally, I consider myself as a plumber in the bank. And that said, we're building the new foundation of the infrastructure. And for all these different use cases and other things we work on, funnily enough, if you think about, they all can be represented with an ERC20-like token, right? So technologically, they all look alike, so to speak. But in an asset sense, legally, it is very different. Process-wise, it's very different. Each asset has a different life cycle. But the DLT, the blockchain space, has brought this new abstraction layer, which has enabled us to bring all of this together onto this new common infrastructure, right? And this is one of the things, as I said before, why cash leg and asset leg, this is a new infrastructure where they all coexist. Right? Traditionally, in a bank, that would have been two different divisions. Here, they're coexisting, and that means we're able to do new things, things like DVP, but near instantly, right? So reducing that risk of settlement, albeit for PVP, and in essence, so I would say it's about the new plumbing, build ground up new, fully automated. For this world, and how would the world look like if we could build it from scratch? That's the proposition here.
Marianne, I would like to come to you and ask you. Your bank is really innovative. Is a really innovative organization. You are active in this space. How you see value generated from the tokenization of assets, and what kind of organizational and regulatory challenges you see in the process of tokenizing
Sure.
value?
Yeah, sure. Thank you. I should say a little bit about Standard Chartered first, because I appreciate it's not necessarily a household name here in Europe. We operate across 60 markets, predominantly in Asia, Africa and the Middle East, across wholesale, corporate and retail banking. And we're pretty pro-digital assets, I think it's fair to say. We believe digital assets are a permanent and important part of the future of financial services. And we have a pretty strong level of conviction that at some point in the not-too-distant future, significant parts of financial market infrastructure, products and services will be tokenized in some way. We already have a number of live crypto asset initiatives across the group, mainly through our Standard Chartered Ventures arm, but we're also exploring a number of tokenization opportunities as well. And I think the key point there is exploring, because I think, as we observe it, most of these projects are still in an exploratory stage rather than, truly commercial yet. But we are hopeful to get that we will get to that point at some point soon. So I think in terms of the benefits, we've got a good idea of what they are, but I don't think we'll really know the true benefits for quite some time. But just to talk through a specific example, I suppose. So one project we have is called Libera, which is an asset tokenization platform that, again, we've set up through our Standard Chartered Ventures arm. And that helps companies create, issue and manage real-world assets on-chain. There's two main parts to it at the moment. One, which is offering tokenization to regulated fund managers, allowing them to sort of issue tokenized fund units directly to clients, investors, both retail and wholesale. And the other main use case at the moment is enabling central banks and government treasuries to directly issue tokenized bonds in any denomination, again, directly to investors. And I think in terms of your question, Demetrius, that's where we see one of the real benefits. It's that functionality, it's that simplification of accessing investors and removing that complex web of intermediaries that we might be sort of more used to. And I think from an end client's perspective, that's probably a good thing. Another key point for us, and this is particularly important for Standard Chartered, given we operate in so many emerging markets, is the financial inclusion point. So in terms of the lower bond denominations that Joshua referred to, we're seeing that. And I should hasten to add, this project is in Singapore, but it's really potentially going to revolutionise national savings there as we see it. In terms of the regulatory challenges, I think it's, maybe I am slightly biased as an ex-regulator myself, but I think it's really important to distinguish firstly between regulatory challenges and genuine regulatory blockers. And we don't actually observe a significant amount of genuine blockers, and we're actually very heartened by a lot of the efforts we see from our regulators across all our major markets to help facilitate this innovation. That's a really fantastic thing, and particularly the case here in Europe, we would say. I think the challenge is, frankly, for us, particularly as a bank, is really the capital treatment and how the prudential treatment will be handled in terms of how punitive that capital treatment might be and whether that differs significantly between public and private blockchains. Just coming back to just one more point, and then I'll pause. But coming back to the Libera example I spoke through of the project and why that was particularly successful in Singapore, we were able, for the fund management case, we were able to fully rely on existing securities and fund regulation, which really, again, simplified things, provided clarity, and enabled Moody's to rate that fund as AA. So having that regulatory clarity, I think, is a really important stepping stone to allow the ecosystem to flourish. So that's what I'd say for that on that one, Demetrius.
So, Marianne, you touched upon the subject of inclusion. So you see this innovation trickling down to the end customer and creating efficiencies for them, so making the access to these products much easier and less costly, right?
Exactly, yes. It's having access to products that you probably wouldn't have otherwise had access to, minus the technology, and accessing a pool of customers that are either sort of unbanked currently or at least underbanked, which is a particular issue in many of the markets we operate in.
Thank you. Jens, I would like to ask you, what is this project you have in Deutsche Boerse with the 7 billion bond you put on chain, and what kind of considerations you had in your mind before making the decision to actually tokenize something which is very easy to perform in an established market without many liquidity problems? And I would like to ask you if you believe that tokenization is an enhancing or a disruptive innovation.
Thank you, Dimitris. Let me first of all probably, like Marianne, spend a few sentences on Deutsche Börse. For those of you who do not know Deutsche Börse, we are one of the leading financial market infrastructure operators in Europe, covering the entire value chain of trading, clearing, settlement, down to custody, and on top, a broad variety of different data and index offerings. And I mentioned it briefly in my introduction that we are on this digital journey since, originally since 2015, in very different capacities. So currently we have a broad portfolio of different initiatives covering crypto, alternative digital assets, and digital securities. And you referred, Dimitris, to an initiative we have, which is called D7. Why D7? Because all our market infrastructures carry the lucky number 7 and D for digital. So our trading systems are called T7, our clearing systems are called C7. So this is why we decided our in production and digital market infrastructure would have the name D7. And probably, unless most of the other players out in the market, we are fully productive with D7. So D7 is real in terms of infrastructure. It has a front end, it has an API, it has a back end, a digitizer. And at the current stage, we have digitized over 15,000 securities. Including one big bond. It was around 3 billion. But I think let me before I come to that bond and to your question, Dimitris, in my view, if you take a step back and if you look at markets from a perspective of a market infrastructure operator, it always comes down to market efficiency. So we build, load, operate markets and market infrastructure in order to increase market efficiency. And this is a bit a yin and yang between market efficiency on the one hand side and market growth. So if you look back in history and look when markets were still physical, so floor trading, physical securities, and when markets were taken electronic, it was like an S-curve. So on the one hand side, it was taking markets to the next level of efficiency and at the same time enabling growth. So bigger volumes, tighter spreads, more securities issued. And I believe when we talk about digital security services infrastructure, it is the next level of S-curve, the next level of market efficiency. And finally, I'm a bit the kind of anti-evangelist against DLT only, in a way, because to me it always comes down to the question, do we provide value to market participants and to create this kind of next level of market efficiency so that market participant can either earn the next euro or dollar or sterling, or can save the next euro. And finally, and this is how we did D7, we are coming from the solution side and working our way back to technology. And then we might decide that DLT is somewhere in the mix if it provides the level of market efficiency we want for the solution. And now coming back to your question, the reason why we have put this big bond on D7 like some other bonds before is simple, that with D7 the issuers get faster access to liquidity. So from the start of the issuance process of a bond till money on the account of the treasurer, we could reduce between a time period between 5 and 7 days down to 2 days. the 15,000 products which we have launched on D7 are mainly structured products. And with structured products, we have brought down the time from product design and issuance to issuance and listing down to less than 10 minutes, which means the issuer can design its product mark to market and distribute it right away. And this is measurable value created by a digital infrastructure. And this is what I meant when I made my intro. So to me, it's not the question whether you use DLT or not. To me, the question is, can we provide a measurable value add to the clients and to the users of a digital security services infrastructure? Now, is DLT a disruptive or an incremental technology? In my view, there are two ways of technologies. Those who are incremental, they do not change the way value is created in a market or in an industry. And those who are disruptive, and disruption does not happen overnight. A lot of people think like if this disruption, you wake up all of a sudden the world is different. It's not. But disruptive to me is a technology which has the potential to change the kind of how value is created and allocated in an industry. And DLT, in my view, is one of those technologies which has the power and force, even though it needs some more, I think, things fall into places. And again, in my view, DLT is not the kind of hammer to all the nails. It is one of the new technologies you would need to build a market solution, at least in our view.
Thank you very much, Jens. Andrei, you are the economist. You just heard the people who put billions of euros, dollars, pounds into this kind of projects. I will try to, when I was trying to figure out if all this makes sense, I would start very simply with a net present value calculation, see if I can create cash flows and then try to discount them from where the cash flows could be improved out of market friction reduction, out of improvements in liquidity, verification costs, transaction costs. Do you see improvement in the pricing of an underlying asset if you see tokenized? Do you see more fluctuation? You see more riskiness? You remember Robert Merton's book that every financial innovation brings more volatility in the market. What is your take?
Thank you very much, Dimitris, for having me here, and thank you, the organizers. Thank you very much. Wonderful panel, and I teach many different streams of students, and one of the most challenging students that I have to teach are called executive MBAs. So these are people who've been, around for 7 or 8 years, and they are very dynamic. They also pay a lot of money to be there, but they're not very technical. So I have to explain things to them in metaphors. And so I'm going to start with a metaphor. I'm going to try to link it together. And then I'm going to move on to something a bit more fundamental. And my main gauge of how well I'm doing teaching is by looking at my audience and seeing whether or not they're using their devices. If they're using their devices, that means I lost them. That means that there's something on their device that is more interesting than what I have to say, and I need to entertain them more. So I'm watching you. So if I see you using your devices, I'll try to move on to something a bit more entertaining, so including those people on the panel, by the way. So
we are not using our devices.
So I've heard the words plumbing, inclusion, liquidity, and I thought of, as a metaphor, I'd like to use for you the water system. It's actually not very recent that access to clean water has been made available in Europe and other parts of the world. You can have access in your home to clean water, and importantly, you do not need to check for the quality of the water. You can trust the water coming into your home. It doesn't happen in every part of the world, and there are many parts of the world in which you cannot take for granted that A, you're going to get access to water, and B, that water is going to be clean, that is actually not going to poison you. And some of the sort of older systems of getting water to your home were very manual, involved literally carrying it. And liquidity that comes with it, and there are different types of water. Once you have access to sort of clean water and take it for granted, you don't need to check again the quality of it. But in the back there, you can also see bottled water, which is a premium water that you can also go buy. And it's a water that could be brought to you as far as New Zealand. They'll actually take it in New Zealand and bring it over to you, right? So you can have premium water alongside water that you can just get from the tap, which is regulated. So what's interesting about the water that comes to you now in let's say, Europe, is that the quality of it, you can say, stays pretty much the same. And which brings us from that metaphor into an area of tokens. So tokens could be, to me, of two kinds. They could be what sort of in the parlance of finance is called information insensitive, meaning like water. You don't need to check for whether or not water is going to fluctuate depending on the quality of water, depending on time of day, or what day it is, or whether it's spring or fall or winter. It's going to be information insensitive. And that water is very, very useful because you can use them for payments. You don't want to be checking the value of your token, whether it's changing, not changing. So with some of the decentralized crypto assets, the value keeps fluctuating. So it is information sensitive, and that makes it less useful for payments. So if you want to use something for payments, you want to have something that is a token that's information insensitive. It's one yesterday, it's one today, it's one tomorrow. If you're looking at the token side on the asset side, you want to actually design tokens that are information sensitive. As information changes, as you said, you can issue a report, and something has changed, and 30 minutes later you want to close it. You want to close it presumably because something has changed, not because you're like, oh, I don't feel like having it. So how do you design then tokens that are both information sensitive and information insensitive? So information sensitive are going to be the ones like premium water that are in the back. You can look at pH, you can see where it's coming from. The price of it is going to fluctuate. It's going to be made available to you at different prices. You go to the airport, they'll sell you for $4.99, right? So and something that's insensitive on the liability side. On the information insensitive bit, there's a bit of work that's been done on stable coins and central bank digital currencies, and you can say that work continues. On the information sensitive side, you can ask yourself, kind of like, how sensitive do you want it to be? Do you want it to be as sensitive as Bitcoin? Do you want it to be less sensitive? And that's where sort of regulators come in and determine how sensitive something is. Because different sensitivity is appropriate for different circumstances. You want assets to reflect information. That's the fundamentals of finance. You want the prices to reflect information. You make something insensitive, then you need to control quantity, right? You'll need to in some way adjust how much of it is there. Like with money, you need to look at monetary aggregates. If it's information sensitive, then you can go and the price then accumulates that information. You just issue it. You take it out with respect to sort of your clients. So the economics of it, to me, I think needs to sort of take into account, and regulation needs to take into account in some way the sort of and be very clear about it. Here's what we want to do. We want this particular class of tokens to be responsive to this type of information in the following way. And then I think there could be an understanding of where the market forces organize themselves around. What do they consider to be useful for them? What kind of infrastructure do they want to build for that? For how much they want to sell it? Whether it's a super premium water available at certain times, or it's just or it's something else. They would not be interested in just providing water. That's, I think, is going to be provided by utility type of environments. But there are possibilities there.
Mm-hmm. So in that case, we are talking about not tokenized assets. We are talking about smart assets that you can blend them with oracles and machine learning and add features that fluctuate interest rates, adjust interest rates.
Because you want to pull in information into them. If you don't want to pull in information into your token, it has to be as dumb as you can make it. No oracles, no code, no smart codes, nothing. Because why would you want to do it? You don't want it to fluctuate in value. You want it to just sit there and be as dumb as it can be, and just monitor it, just make sure that it works, right? If you want something smart on the asset side, you need oracles, you need to build in logic, and then how much of it would then be determined by, what's the demand therefore?
Sure.
Does that make sense?
Absolutely. Does
okay,
it make sense?
I see only 2 phones out there, so I think I've done okay.
Peter, obviously, the market has the appetite to explore further the tokenization of financial instruments, either by using blockchain or blending blockchain with artificial intelligence and creating smart contracts. Obviously, again, we are in a moment that people explore what they can do with that and from where the value comes. As the official of the European Commission, do you see value for the tokenization of assets, and what we need to do in order to scale the innovation without regulatory frictions?
That's a very difficult question. So at the European Commission, we are in the business of serving people and serving the single market. And I realize now that I thought that the FISMA had some responsibility in this area, but I realize now that I have to speak to the Commissioner for Water to really get advice as to how to develop policy on this. But we don't have a Commissioner for Water, so maybe the electricity people or so are close enough to it. And is there value in tokenization? The short answer is I don't know. But the longer answer is that lots of people come and see us and me and say there is. And they come with reports and data and they illustrate say there's value. So, and I have no reason to doubt them and I have no ability to disprove them. So I have to use the assumption that there is value, especially because, and I compare this to crypto assets. When we did crypto assets regulation, when the design of the MiCA regulation was done in 2018 and 19, so way before Libra ever came onto the market, most of my colleagues in the financial services department who deal with serious issues said that I was wasting my time, I was doing the devil's work, all of this crypto stuff was going to fall under its own weight, forget about it, this is useless, you're just facilitating criminals and money launderers and it's not worth doing. And at that time, I think that the serious bankers and the serious financial market infrastructure people, and some of them are around the table here and there, would not want to be caught dead near anything to do with crypto or DLT. They said DLT is not for us, forget about it. So that's also why when we did MiCA, we did not go into the area of regulated financial services or financial instruments with the exception of the DLT pilot, because we said, let's try it a little bit. And now things have changed. So we're now 5 years further, and all financial institutions I see, be them banks, fund managers, market infrastructures, they all want to talk about tokenization and the fact that there is great value to be created, great value to be unlocked, either by efficiency, cost saving, liquidity. And these are figures, if I look at the reports which I received, are in the billions and even in the trillions of dollars. Now, $1 trillion is an awful lot of money. But they say, look, if we can do this, we're going to unlock trillions of liquidity. Now, who can be against that, unlocking trillions of liquidity? Of course, you could create some inflation, but that apart, that's something great to pursue. So my first reaction was, if this is such a great opportunity, why don't you go ahead with it? What's stopping you? And then the question is, well, yes, there's, first of all, we need to have cash on ledger, because it's pointless to do this if there is no cash on the ledger. So you need a payment instrument. Could be central bank money, could be tokenized deposits, could be stable coins, but you need vast amounts of cash because these markets are huge. Secondly, they say you need to have secondary markets that also operate on distributed ledger, because otherwise these companies can issue all kinds of stuff, but there's a limit to how much the professional investors can absorb onto their own balance sheet, so you have to distribute this in the market. And thirdly, they say there are legal issues. And then the question is, well, are these issues which result from EU law? Are there barriers, unclarities, things that prevent you from doing it? Lack of technology neutrality? Or is this a matter of national law? And there we see that so far the only indications we are as well, it's questions of property law and national civil law, which our eyes always glaze over when people raise that, because we say, well, life is too short to deal with that, so can't help you on that. But if there are genuine issues in EU regulation, be it MiFID, EMIR, CSDR, collateral, finality, whatever, people in the industry who want to move forward and want to seize this opportunity should come forward and tell us what these issues are and why they can't do it, because we are here to serve. Because if there is indeed this opportunity, it would be irresponsible of the European Commission not to pursue it.
Spoiler alert, if you, dear bankers, have any problem with MiFID II, Market Abuse Directive, Listing Directive, Prospectus Directive, CSRD, and some others, you need to go to Peter and ask changes.
If it prevents tokenization.
If it prevents tokenization.
I'm not listening to other problems.
Okay. I knew when the panel started that I will not cover all the topics that I wanted in my panel, but I'm confident that I have one more round of questions for all of you. And, okay, we tokenized value. Now we need to operate on a financial value network, which includes placement, trading, clearing, and settlement. And blockchain, in theory at least, can help us streamline this operation. The best DLT-related regulation of the European institution is the DLT pilot regime, not MiCA, for two reasons. First, because it was my last regulation before leaving the Parliament, and second, because it has to do with assets, the cumulative price and value of dwarfs Bitcoin and everything else around it. Andre was working very hard on this very technical and very dry file. So I would like to start this time with Marianne, asking her, because he used to be regulator, do you see a future without clearing houses?
That's a really big question, and one of the points I was going to make is we can talk about regulatory issues, I think, until the cows come home, because there are some issues, I think, to Peter's point. The significance of those, I think, it might differ depending on your view and your opinion, but I think regulation is certainly not, in my opinion, the biggest or the only blocker to these markets scaling. I think one of the issues that's actually maybe slightly less spoken about, and to answer your question, Demetrius, there are inherent conflicts of interest present in this to help these, which prevent, I think, these markets scaling. There are parts of the market, frankly, which may stand to be disintermediated if this technology takes off in the way many of us think it will. So I hope that's my diplomatic way of answering your question, Demetrius. But I think something else I just want to say about the regulation, and to your point, Peter, about crypto assets and the attitude towards crypto assets. I think Standard Chartered is maybe a slight outlier here in that we do have live crypto asset initiatives, and I'm talking crypto assets here, not tokenized traditional assets. We already have a live crypto asset custodian and a live crypto asset brokerage and exchange, again through our Standard Chartered Ventures arms, and we will soon be launching crypto asset custody in Dubai as well. And the reason for that, we don't necessarily think crypto assets is the end game. We are sort of, I think, aligned with other peers in that we do think tokenised traditional assets is more the end game. But the learning that we've gone through as an institution through getting these crypto asset initiatives off the ground, and frankly, that's where the liquidity is at the moment, and hence there is some commercial opportunity there. The learning that we've gone through from a risk management perspective is really quite something. And I think about our first foray into crypto assets, which was our first investment in Ripple in 2016. And our whole risk management framework in regards to digital assets has incrementally enhanced year on year. The learning that we've gone through has been hugely, hugely valuable, and we hope sort of sets us up in pretty good stead. So I think the point I'm coming to is the regulatory attitudes, and I think the political rhetoric around crypto assets and digital assets is actually possibly more important than the actual regulation itself. We have not yet come across any genuine regulatory blockers that have prevented us from moving forward in the endeavours that we want to explore. But it's the attitude and the openness of regulators and policymakers, which I think is really, really crucial for innovation. Yeah, that's what I'll say there.
And very briefly, do you believe tokenization and DLT-enabled financial infrastructures accelerate the competitiveness of financial system, yes or no?
Yes.
Joshua, why you don't use the DLT pilot regime sandbox of the European Union?
Presumably I have to caveat this is my personal opinion, and it's not an opinion at all. No, I mean, I wouldn't... Can we ask a different question? Because the short answer is as an institution, we are also a German bank, as you know. So
I'm going to ask another question.
Yes.
I can chip in here.
Okay.
So, no, because probably we are a bit in the same camp. I mean, being a large market infrastructure and being a large market participant, right? I mean, to be fair, if I take a picture, we are both operating like super tankers or kind of aircraft carriers. And now all of a sudden you're operating an aircraft carrier, 10,000 people, you have your course, and then someone steps up and says, hey, what do you think about redoing your kind of runway to land and operate a Cessna? You say, and then say, oh, by the way, only for 1 or 2 landings and takeoffs. And then this is a bit the situation when you operate large-scale infrastructure and sandboxes, right? So probably it's fair to say that to a certain extent sandboxes are not very much geared towards big market infrastructures and big market players. And by the way, the same is true when you want to integrate kind of small pieces of market infrastructure into your legacy. I mean, we've talked about D7. Clearly, 80% of the efforts in D7 is not building 7 smart contracts for each and every digital instrument in the kind of modeling language. But 80% is integrating it into legacy for settlement, for the reporting, for the asset servicing. You cannot model within DLT yet, etc., etc. So it is a bit the question of coming back to like value and creating value and kind of building such a piece of infrastructure for like a piece of plastic or throwaway. I'm a bit extreme now. Is always it comes down to an economic decision. And finally, if we want to build infrastructure, and same is probably true for our market participants, then you take a long-term view. You want to be sure that regulation is really paving you the way and setting the rails on which you can then invest, finally. Mm-hmm. And finally, once you have invested, you need to load in order to scale, because otherwise you will never get a payback for your infrastructure. In my view, the answer is as simple as that. And to a certain extent, we love, as Deutsche Börse Group, we love to build infrastructure based on, so to say, real and sound regulations, so that we ensure that our investments, which we do in order then not only for us but as well for our market participants, that it is paying off and that it is properly loaded.
Mm-hmm. I want to ask you exactly the same question like I did for Marianne. Do you believe that tokenization and DLT-enabled financial infrastructures will strengthen the competitiveness of the European financial system?
Before, if I may also clarify, I wasn't saying yes or no. I couldn't comment on anything. And to also stress that we are very active in the European space. And to Jens' point, I think we are focused, as I said, I'm a builder, so we build products. So for us, pilot or not, I mean, we have to have an end runway of a pilot into production. So yes, so pilot or not, we are building, we are active, just to clarify the message.
Absolutely.
And we will take part in the ECB trials, obviously, very much so, which is a different story than the pilot regime, in my view.
So yes or no on the question?
Good question. So the question was around the
competitiveness of the financial system of Europe.
It definitely will, in my view, be a strong element for our competitiveness in Europe in a very, very positive way, in my view.
May I ask another question? What kind of tokenized assets you see in the future what kind of assets you see in the future being tokenized faster? And what is the determinant of the choice which asset to tokenize and which to wait?
Again, I think telling the future is hard. If I knew the answer, then obviously I would be building it. But in a sense, we are. So I think to touch upon what we discussed so far, I think fundamentally the reason why we're doing tokenization assets or cash side is one for risk reduction, efficiency, new opportunities of even building markets, so to speak, right? And so there's no right answer to it. It's very much a client-led point, as in what value does it drive to them. And so in the near term, based on the things I've said, which is intraday repo, collateralization, JPM Coin, which is around moving liquidity 24/7, where payments traditionally is a business of exceptions, right? You have a US dollar holiday, you can't move, sorry. All that goes out of the window in this new system, right? It's always live, right? There's something else you can also do when it's on a DLT, a shared ledger, which is you can stitch things together, right? So I just want to put a scenario in mind. What we could do when you have these systems together is, imagine it's 9 o'clock Monday morning, London time, and you get a margin call, right? And your traders are sitting in Singapore, but your assets are in New York, for example, right? And you don't have enough liquidity. How do you deal with it? It's a very scary moment, because that's a scenario where you're facing liquidation if you don't meet the liquidity needs at that moment. That's a scenario where we could help, for example, with intraday repo, where if you had assets, let's say, locked in Tokyo, you could tokenize it, use it as collateral, use an intraday repo maybe in New York, right? Get that user funds, close your position for the margin call, and then possibly your revenue or your income comes from maybe in Hong Kong. That might come later in the evening, but you close your intraday repo position back in New York, right? In all the scenario, you could automate the whole process end-to-end completely. And especially when the risk and the opportunity is well understood, that's when digital systems, AI systems can actually act upon it. So I think that's the future I want us to imagine, is a highly automated, highly aware, very low risk or risk, essentially. But also the fact that we're able to access and move liquidity just in time, where you need it, when you need it, as opposed to having to plan months in advance, a lot of folks involved. That's the imagination I want to sort of leave in.
ONYX, right?
Absolutely, that's the heart of ONYX. So in terms of your question, what asset next? It could be anything. It very much depends on the client demand, and we are actively building products based on what we hear for clients, not just in one location, because many clients are global, right? They have operations in Europe, US, Asia, elsewhere. So for them, it's about managing liquidity, not just in one place, but globally, especially if they're a treasurer. So having that global view and having that ability to do things, again, globally. So, having a product in one jurisdiction doesn't solve it. You need to have these things tied in across in all these infrastructures. So back to your harmonization point, right? So.
A financial infrastructure can be centralized as we have them widely all over the world, and it can be also decentralized. So I have exactly the same question for the academic and for the regulator. What is the end game of the story? A moment where the exchange is going to be a blend between centralized and decentralized operation, or DeFi? I would ask the professor first.
Thank you very much, Dimitris. So I think of more and more as I look into it, and as I hear colleagues, and as I've been getting more into this, I think more and more of finance as a technology stack, as software, and there are different types of software architectures that you can think of. And there is something interesting that software architects have come up with, one of them in particular in the late 1960s, that ended up being called Conway's Law. You don't have many things called law in software architecture, but this one basically says that the communication system within your organization or within your community is going to be directly reflected in the architecture of your product or service. And the way it came about is that there was an early software architect who gave the same task to do to 5 people and 3 people to build a compiler. And the 5-people team built a compiler which consisted of 5 steps, and the 3-people team built a compiler that consisted of 3 steps. And then he tested it again, and he kept seeing this, that if you have 3 parts of the organization talking to each other, then you're going to have 3 different sort of blocks of code within your architecture, because these are the people who share information. That's how they're going to build it, and it's going to interact with other parts of the code, right? So having something centralized, if it's, for example, if it's built with the purpose of latency reduction, reducing the period of time between events, something that you need very, very quickly, you're going to build it centralized because that's a way to reduce latency. Why would you want to build a system that has to communicate with 55 other parts of it if it's not going to reduce latency for you? If you need to have if you need to build a system that is able to pull information from different sources and find a way to organize it and determine the price or determine something that others could rely upon, or see into or be more transparent. So if you want to have a system that's more transparent, for example, then you want to build a system that is more decentralized. So I would say it would be sort of built for a purpose. They will coexist in some way, depending on what they're built for. So underneath it is not necessarily sort of how the architecture is going to be designed. It's who is talking to whom, who is communicating with whom, and how do they need to communicate. If people in Hong Kong need to communicate with people in New York and need to communicate with people in London, and they need to communicate very, very quickly, and it has to be a latency reduction thing, that they're going to do it. They're going to use something that they built in a centralized way inside that product because that gets the job done. Now, if people in London do not really trust people in New York, and people in Hong Kong are not really sure if how they want to do things, then decentralized makes more sense, because then you can go source it. It'll take less time, but it will get you to where you need to be.
Mm-hmm. Peter, I'm afraid to ask you about decentralized finance, because Commission is up to something. But I would like to ask you, what is coming in the next 5 years mandate? What we should expect from DG FISMA for the new legislative period?
Well, you're asking me to predict the future. I'm very bad at predicting the future. There are known knowns and unknown unknowns and so on, but when it comes to MiCA, there is a requirement in MiCA that we do a report covering a number of issues, NFTs, decentralized finance, crypto lending, and the Commission almost always, or at least very often, does what it's told or asked. So it's extremely likely that we will produce that report somewhere around the turn of the year. The deadline is December, but I would be highly surprised if it was actually released in December. And that report may or may not contain ideas on policy or regulation of decentralized finance, or on NFTs, or on crypto lending, or on staking, or on any of the other issues that are popping up. Now, I think that the likelihood that we'll say something meaningful on decentralized finance is limited, because true decentralization escapes regulatory dogma. Because if you look at regulation around all over the world, regulation is always focused on intermediaries. You administer the rules through the intermediaries. They have to comply. Now, how are you going to regulate a system in which there are no intermediaries? So we define decentralized finance not by which technology is used, but by the absence of an intermediary. Now, some people, if you scratch a bit at the surface, you find the intermediary, but there is also activity where there's genuinely no intermediary. Bitcoin blockchain is the best example. There really is no one behind it. And that's why it's very hard, if not impossible, to actually regulate it using existing doctrines of regulation, unless, of course, you are a totalitarian state and you just ban it, you just prohibit your people from engaging in this activity, which doesn't really work very well. And it's unlikely that we would have a legal base in the treaty to propose a ban if we wanted to. But we'll be looking at these issues. Tokenization, if people come forward with concrete evidence that there is a problem with one of these wonderful pieces of legislation that you mentioned, we would be derelict in our duty if we wouldn't be looking into this seriously and seek to address it. So I think that that is likely to occupy us a lot. For the rest, in the crypto space, maybe it's a blessing for the crypto space, but a lot of attention is moving away from DLT and blockchain and into AI and other stuff. Some people regret this. I think it's actually a blessing, because then also all the excitement goes away and you can do serious stuff rather than working in the spotlights, sort of trying to convince people that this is not just one big money laundering conspiracy, which still is the predominant view about crypto. I also want to say something, because you didn't ask me the question, but I'll answer it anyway, is, are people going to be disintermediated? Don't we need clearinghouses? Of course, clearinghouses are a risk mitigation effort. So if the technology stack develops and the business models develop in such a way that the risk that is currently caused by clearinghouses is no longer in the system, then you can do away with the clearinghouse. But if that risk is still there, you need a clearinghouse. And I'll now give you an anecdote. The very, very, very first meeting I had about blockchain was in the Financial Stability Board's Financial Innovation Network. And it was a meeting in the New York Fed, in the basement of the New York Fed, a very austere building. And on the one side of the room, there were central bankers, looking like central bankers look. And you can make your own picture as to what a central banker looks like. There's a few, or there's at least one in the room, and he doesn't look anything like a central banker. But they looked very much at the piece. And on the other side, there were hoodie-wearing geniuses, lunatics, libertarians, blockchain folk.
Libertarians are lunatics, said the official of the European Commission.
I'm not saying that the libertarians were lunatics. I said there were lunatics and libertarians. And they sort of said, well, we're developing this blockchain and Bitcoin and what have you, and this is the demonstration that there is absolutely no need for central banks. This is the end of central banking, which I thought was quite an entertaining and interesting position to put forward, especially at the New York Fed, in a room full of central bankers. Clearly, the central bankers had no idea what these people were talking about. And clearly, these hoodie-wearing libertarians and lunatics had no idea what central banks did and why central banks are important. And if we didn't have central banks now, I'm sure that they will end up being created to control the risk. In the same way, will DLT be important for competitiveness? If we didn't have financial market infrastructure now, imagine Jens walks into this office tomorrow and there's nothing there. An empty building, no computers, no nothing. And Jens's boss, assuming he has a boss, tells him, you have to build infrastructure. I am absolutely convinced that DLT will be a much bigger part of the technology stack Jens will use than he currently does. Because, of course, now they're sitting on huge amounts of legacy infrastructure, which is working okay, so you're not going to throw it overboard. But if you have to start from a clean slate, I'm convinced that DLT would be a much, much bigger part of the technology stack.
Mm-hmm. Thank you very much, Peter. I hope that next two panels will not take that long, because we don't have time for that long panels. But I think that it was very, very interesting, and please join me in a round of applause for this wonderful blend of people. And there is something that I would like to share with you. We have the honor of having today with us Andrei Kirilenko, a person who is not just an accomplished economist. He is also a very big patriot, helping his country, Ukraine, in very, very difficult times. And he suffered a tremendous loss in this process. And you know, there are two ways to be decorated from your country. You can be decorated by your president, your king, but also you can be decorated by the soldiers in the first line. I was asked by the soldiers in the first line to deliver you this. This is yours.
Thank you very much.
The people from Bakhmut and Avdiivka, and the person who actually brought these signatures, we lost him in Avdiivka on Wednesday.
I'm very sorry to hear that. Thank you. Thank you.